Here's the deal. There's a company that was once considered a darling of Silicon Valley. It was once worth close to $50 billion at its peak. And now it may be worth $300 million. What happened here? Let's go back to the beginning. Let's say you've just started a startup. Congratulations, by the way. Now it's time to find a place. In a post-COVID world, remote work might still be the norm, but the idea of working in an office space is not dead yet. Yet, there are challenges there when it comes to finding an office space. There are long-term leases, investing in infrastructure and maintenance, and a need to find prime locations. It could be hard to secure office space quickly and easily. That seemed to be the value proposition of a company called WeWork. WeWork is a provider of co-working spaces, including physical and virtual shared spaces. The idea was to create a collaborative environment where there could be high-speed internet, office supplies, meeting rooms, printing facilities, and communal areas. And if you care about more amenities, there may be complimentary coffee, beer on tap, and wellness services. As a business, you may need to scale operations up or down as needed. So, this could be a cost-effective solution for startups and enterprises alike. As a company, you could easily add or reduce the number of workstations or private offices you rent. And you get to be in a location that has prestigious buildings and prime city areas, providing you with a professional image. That was the WeWork idea. And it's set to serve small and large businesses with office space across close to 780 locations in 39 countries. However, in October 2023, it may be teetering on the precipice of bankruptcy. This could cast a gloomy shadow over the enterprise that was once touted as the future of workspaces. What's going on? What's up? What could have happened that would have led Masayoshi Son of SoftBank to remark, "It was foolish of me to invest in WeWork. I was wrong." WeWork was founded by Adam Neumann, Rebecca Keith, and Miguel McKelvey in 2010. In 2011, Neumann remarked, "The 1990s and early 2000s were the I decade. The iPhone, the iPod, everything was about me. Look where that got us. In a terrible recession. The next decade is the we decade, where collaboration is the future of innovation." There was said to be a vision to address the changing dynamics of work and create a new kind of workspace that would offer more than just a place to work. Neumann, Keith, and McKelvey were said to have recognized that traditional office spaces and work arrangements were evolving. The rise of freelancers, remote workers, and entrepreneurs may have meant that many people were seeking flexible work environments and collaborative communities. The founders aimed to create a space where people from various backgrounds and industries could work together, share ideas, and form connections. Neumann and McKelvey were said to have entrepreneurial backgrounds, and they were said to understand the challenges faced by startups. They wanted to provide a supportive and innovative environment for entrepreneurs and small businesses, seeing an opportunity to utilize underutilized or vacant office spaces in prime locations. It was said to quickly become a global phenomenon in the real estate and office space industry. The first WeWork space was established in a 3,000 square foot area in Manhattan in the US. The concept seemed to get popular and the company experienced rapid growth. They began opening new co-working spaces in various locations across New York City and later in other major cities in the US. In 2011, WeWork received its first significant funding from investors like Waterbridge Capital. With the success of its early locations, WeWork was set to have embarked on a global expansion in the following years. The company ventured into international markets such as London and Tel Aviv. WeWork's valuation crossed the $1 billion mark in 2014. That's when it earned unicorn status. The WeWork narrative was said to be amplified through lavish events and brand partnerships by co-founder Adam Neumann, who was thought of as cool and magnetic. WeWork also forayed into sectors like We Live and Rise by We. We Live was WeWork's foray into co-living spaces. The concept was to provide flexible and community-focused residential living arrangements. This was much like WeWork's shared office spaces. WeLive buildings were said to have featured fully furnished apartments, shared common areas, and various amenities. Tenants could rent individual rooms or entire apartments on a short-term basis. And Rise by We was WeWork's attempt to enter the wellness and fitness industry. It offered a combination of co-working spaces and fitness facilities. These spaces featured workout areas, yoga studios, meditation rooms, and health-oriented services. The concept was said to have aimed to cater to the growing trend of people seeking a healthy work-life balance by providing not only a place to work, but also an environment to support physical and mental well-being. However, this kind of diversification may have stretched the company's focus, drained its resources, and ultimately contributed to its financial challenges. In 2017, Masayoshi Son's SoftBank Group made its first investment in WeWork. It had infused the company with about $18.5 billion over the years, and WeWork attempted an IPO in 2019. But as the IPO neared, there was intense scrutiny. Just imagine, this started as a shared office space provider, but expanded its offerings to include services such as event spaces, on-site amenities, and community-driven co-working environments. The business model was built on leasing or acquiring office space and then subleasing it to individuals and companies. This included short-term contracts, scalable office solutions, and a range of membership tiers. All of this sounded great in theory, but there were concerns about Adam Neumann's leadership style, profligate spending, supposed creative accounting practices, and conflicts of interest. With the prospectus unfolding, so did alarm bells ring. The company was rebranded to the We Company. Certain We trademarks had been exchanged for about $6 million in stocks. The payment went to an LLC controlled by Adam Neumann. So, Neumann changed the name of the company and then paid himself $6 million for the new name. This raised concerns about potential self-dealing, adding to discussions about Neumann's close ties to the company he co-founded. Although his holding company later returned the shares, the damage seemed to have been inflicted upon potential investors. He had also leased properties he owned to the company. These concerns led to Neumann's resignation and the postponement of the IPO. Also, WeWork was said to be aggressively expanding. This was said to have led to operational and financial challenges. WeWork was said to be over-leveraging and spending that incurred significant debt. They opened new co-working spaces in many cities and countries. This expansion required substantial capital investment in the form of securing real estate and building out office spaces. So, they had to continuously secure more and more members to cover their expanding lease liabilities. This strategy could only be sustained as long as membership growth continued at a rapid pace. WeWork was said to have leased office spaces in various locations, often signing long-term leases with landlords. At the same time, the company offered flexible, short-term desk rentals to its customers. This created a situation where WeWork had significant future lease payment obligations due to landlords, which amounted to billions of dollars. So, these long-term lease obligations were basically debt in the form of lease liabilities. And WeWork had to meet its lease payment obligations. But its income streams were less certain, especially during economic downturns. Imagine a period like COVID-19. With a reduced demand for office work, WeWork's members had less incentive to pay for desk rentals. This downturn in revenue, coupled with its substantial lease liabilities, exacerbated the financial difficulties. And the ability to meet financial obligations was impacted, which concerned investors, leading to a decrease in WeWork's valuation over time. In October 2019, the SoftBank Group was said to have acquired an 80% stake in WeWork, and it invested an additional $5 billion. The company laid off about 2,400 employees. A seasoned real estate executive called Sandeep Matrani was appointed as CEO in 2020. That's Indian representation right there. He was appointed to steer the company towards financial stability. But the pandemic shook things up, and in 2021, WeWork decided to go public through a SPAC merger, also known as a special purpose acquisition company. A special purpose acquisition company is like a blank check company created with the sole purpose of raising money from investors through an IPO to acquire or merge with another company. So, a SPAC called BoX Acquisition was formed. BoX was created with the sole purpose of raising capital from investors through an IPO and then using that capital to acquire a private company. BoX went public through its own IPO on a stock exchange and it raised funds from investors. WeWork was the target company for the merger. BoX and WeWork entered into negotiations and agreed to merge. This merger involved a financial transaction in which WeWork essentially became a publicly traded company by merging with the already publicly traded SPAC. After receiving shareholder approval and meeting other regulatory requirements, the merger was completed. WeWork effectively became a publicly traded company listed on a stock exchange under its own name. The SPAC, BoX, no longer existed as a separate entity. So, the merger allowed WeWork to go public without the traditional IPO process. The company was set to revise its strategy, focus on key markets, optimize costs, and cater to larger corporate clients with hybrid work needs. Despite these efforts, WeWork's market cap as a publicly traded company was set to plummeted from $9 billion to under $500 million. According to an SEC filing, the company was said to have disclosed about $11.5 billion in net losses from 2020 to June 2023. And in the post-pandemic world, rising global interest rates were set to have further amplified the risks. WeWork relied on borrowing to finance its real estate ventures. When global interest rates are low, borrowing costs are reduced, making it cheaper for companies like WeWork to take on debt. It may have borrowed heavily, assuming low interest rates would persist. But when rates rise, it may have strained the company's ability to service its debt. So, WeWork is in an environment characterized by oversupply, reduced demand, heightened competition, and macroeconomic volatility. The company is said to have over 18 million square feet of rentable office space in the US and Canada, and its potential failure could have a significant impact on the commercial real estate industry. WeWork's stock market valuation was set to have plummeted by 96% in 2023. In May 2023, Sandeep Mathrani departed, with David Tolley becoming interim CEO. WeWork stated that the losses and negative cash flows from operating activities might raise substantial doubt about their ability to continue as a growing concern. And what about WeWork India? It is backed by Bengaluru-based Embassy Group, which has a 73% stake, with WeWork having 23%. WeWork Global was said to have invested about $100 million in WeWork India. WeWork India is said to not be expected to be impacted by the potential bankruptcy in the US. WeWork CEO Karan Virwani in India was said to have remarked that global developments would have no bearing on the operations of WeWork India. WeWork India was set to end FY 2023 with revenue of 1400 crore rupees and 250 crore rupees in earnings. At present, WeWork India is set to have over 6.5 million square feet of area under its portfolio across only 50 locations in the NCR, Mumbai, Bengaluru, Pune, and Hyderabad. So while the whole debacle of WeWork might be quite unfortunate, especially to those who spent hours, months, days, and years invested in the success of WeWork, there might be some lessons in hindsight. Maybe WeWork grew too big too fast. The rapid expansion could be detrimental without a sustainable business model. WeWork's experience just might underscore the importance of balancing growth with financial prudence. The co-founder of WeWork, Adam Neumann, was said to be super charismatic. He was said to be an expert at selling a compelling narrative. But there may have been a hype surrounding the company that obscured fundamental operational issues. So maybe entrepreneurs and leaders should be cautious about overhyping their ventures because this could lead to inflated expectations that are difficult to meet. Maybe there could have been a grander focus on sustainable and organic growth to ensure the financial obligations align with the revenue streams. WeWork's founders may have had a grand vision of elevating the world's consciousness, but they may have lost sight of the practicalities of running a sustainable business. While visionary ideas may be important, they must be grounded in economic and operational realities. So maybe aspiring entrepreneurs should balance their vision with a realistic business plan, which may not have always been the case for WeWork. All of this might be a stark reminder that exuberant claims and massive investments may not always equate to success. While some might still be slightly optimistic about the future of WeWork, the odds may be stacked against it. Here's to fitting your rhetoric with reality.